It's the beginning of a new month, and that means it is time for your piping hot monthly Bitcoin digest. And in today's edition, we are going to be focusing quite a lot on the macro backdrop. And so if you're looking for a heaping dose of hopium, this unfortunately is not the video for you, but it is extremely important nonetheless. Let's jump in. Welcome back to another video. My name is Ian Major. I'm an entrepreneur, Bitcoin pleb, and all-around raging capitalist. And so as I mentioned, in today's edition, we're going to focus quite a lot on the sort of macro backdrop, the impending energy crisis that's continuing to evolve. What are the different implications and possible scenarios that honestly I think everyone should be thinking about very, very critically at this stage. And then we'll go through some of the highlights a little bit closer to home in the world of Bitcoin. Today is especially important, so you're not going to want to miss a thing. For those returning to the channel, welcome back, my friends. As always, it is a pleasure to have you. And for those new to the channel, I welcome you as well. If you like this type of content, I invite you to consider subscribing and join us in our growing merry gang in cyberspace. I cover all manner of Bitcoin-related content, including a whole slew of tutorials on how to acquire Bitcoin, secure it, privacy best practices, running your own node, as well as kind of news and analysis pieces like today. You want it, I cover it. That is how this works. With all that out of the way, let's go ahead and jump into the first section for today. All right, so let's get going. This is not for the faint of heart. We have obviously seen a lot of chaos unfold over the last few months and have really now started to see things escalate in terms of potential crises, both economic as well as societal in nature. This is being driven really by a couple key factors. Of course, there is the Ukraine conflict. It's interesting to note that when the Soviet Union collapsed in the early 90s, a lot of that energy capacity came onto the world market for the very first time. So that's actually one of the big reasons that energy prices have been reasonably cheap for the last, call it, 30 years or so. And so now that there are all sorts of kind of self-imposed restrictions and sanctions and different things like that, Europeans and, other sort of allies are saying, okay, we're going to boycott, buying Russian gas. We're going to hit them where it hurts. And you also had more structural underinvestment in energy production capacity over the last few decades. And so these dynamics are sort of coming to a head. And while that is happening, you also have the following. So this is the Dixie measuring the US dollar versus a basket of currencies, right? This is just the most sort of accepted way to measure the relative strength or weakness of the dollar. And we have just hit a 20-year high, reaching above 109. Now, we should put this into perspective. This is the all-time chart. And so as you can see, right, it certainly has been higher, but not that often, right? If you go all the way back to this massive spike in the 80s, like that literally required something called the Plaza Accord, where leaders of, prominent nations came together and basically decided to print a bunch of dollars in order to solve this problem because it had become such a massive issue for every other country on planet Earth. And so let's talk about that. Why is that a problem for every country on Earth? Well, it is because energy pricing is done in dollars. If I am France and I'm buying oil from the Saudis, I pay in dollars. So I need dollars. Every country around the world needs dollars in order to pay for energy, at least countries that need to import energy. So for the US, it's not an issue. But if I'm Germany, I can't print the dollar. And as the dollar strengthens ever further, we've seen the crossover mark of the one-to-one parity between the dollar and the euro. And so the euro and basically all other fiat currencies around the world are losing value relative to the dollar. And so if your own currency is losing value to this thing that you need to use to import energy for your nation, that is a recipe for a bad time. That is going to push energy prices for you up even further. And coupling that with the restrained supply dynamics we discussed earlier. Now, why is the dollar strengthening in this way? Well, it's because a lot of people are bracing for what they believe is going to be quite a sharp economic slowdown. We've already seen a lot of different signs of that. And so in such a situation, you might sell some assets to raise cash because guess what? You need to still service your debts. So your income might go down due to a layoff or due to lower revenue, whatever the case is. but you still have the same amount of debt to pay off. And so because there's so much dollar-denominated debt, everyone around the world is clamoring for dollars, which sends the demand for dollars much higher, hence the increase in value. So that's the combination of forces that is leading to increasingly alarming energy prices around the world, and particularly in places like Europe. One of the views that's making its rounds on Twitter is the German year-ahead power price, which has gone absolutely parabolic, as you can see, crossing over €1,000 per megawatt hour, which is just utterly, totally stupid. Now, I noticed this view yesterday. It is worth mentioning that that has turned over a bit over these last couple of days. And so it is worth noting that this sort of, prediction, it's kind of like a derivative on energy, is inherently speculative. And so it's not something that has such a parabolic run up like that is inevitably going to probably have some sort of blow off top. So it is worth noting that. But make no mistake, when your energy prices go up by 5x, 10x, this has enormous, massive consequences. Energy is the master resource that I think the world has suddenly remembered, right? Everything in your entire life has energy at the root. And so energy price goes up, everything else goes up as well. And so we can start to see the impact of that. So at the aggregate German level, as we can see, this is the trade balance that has absolutely plunged. Germany is well known for running trade surpluses, as it is an economic powerhouse in terms of kind of manufacturing, industrials, and the exports that it sends all around the world. With the massive increase in energy pricing, that means that it's spending way, way more on imports. And so the net balance of that is absolutely plunging downwards. And this is a massive concern for the entire Eurozone because Germany is really the economic engine of all of Europe. We can see that here in this more aggregate view where we're seeing the total Eurozone trade deficit that has absolutely plunged. And you can see that very starkly, it's energy that has kind of tipped the scales here. And so the knock-on effects of this are incredibly sobering. Let's continue to drill down deeper beyond that sort of overall aggregate level. We've seen a lot of different things swirling around, such as these examples of small businesses or just, businesses of whatever kind that are now getting hit with just utterly, stupefying, electricity bills that is pushing a lot of them to really evaluate, how do I survive? How do I stay in business? And the fact is that a lot of them are not. They're going to go out of business. We can see that this translates very directly into things like food prices. So this is showing Germany food price inflation, which is rising at a record pace. So 16.6% year on year in August. And that is also very much reflected here. This is showing real negotiated wages. So basically wages adjusted for inflation that have absolutely plunged off a cliff. And oh, by the way, one of the big narratives today, and the Fed has outright come out and said the quiet part out loud in Powell's speech at Jackson Hole, Wyoming. He basically said, brace for pain. And what he means by that is we just do not care. We're going to destroy demand in order to bring inflation down. But one of the reasons that may be too simplistic when we consider the following knock-on effect, right? Alcoa shuts down a third of its aluminum production capacity at its Lista smelter in Norway amid high energy costs. You can see how this starts to spiral, right? Energy prices go up to the point where industrial entities need to shut down production, which in turn drives an even greater kind of supply shortage, which only reinforces all of this. So the idea of demand destruction, just destroying things so completely that inflation finally comes down, that may work temporarily, but it's not necessarily a long-term solution. And so businesses are getting squeezed, individuals are getting squeezed, nations are getting squeezed. I know a lot of you watching this channel are in the US, and so if you think, oh, well, that really sucks, but make no mistake, that comes back to haunt the US as well. If production capacity starts to really go offline around the world, the US imports a lot of stuff. And so those prices are going to come back and be transmitted. And so this is not just a European problem. Japan is in horrific shape as well, less bad than Europe. And so let's think through some of the possible scenarios of how this may unfold in the coming sort of 6 to 12 months, call it. Option one is the status quo. So the Europeans, the Japanese, others who are feeling the pain, they continue to show support and solidarity for Ukraine, by boycotting cheap Russian gas and energy. If this happens at the current pace that things are moving, people in these jurisdictions will freeze, starve, and die. Full stop. That's what's at stake. This will also, of course, have, knock-on effects on supply chains, such as what we just discussed with the kind of Alcoa example. This would be incredibly bad. And you're already starting to see people freak out, in the UK and Poland. I saw a story just now. People are really, really on edge, and they should be. I mean, if you are in Europe right now, don't think that this is just going to kind of resolve itself. Now, that's one scenario, and that's really, really bad. I am hopeful it doesn't come to that. I am hopeful we will see the Europeans and Japanese say, look, US, allies, sorry, right? The fact of the matter is that we're not going to let our people starve and die. And so we are going to go to the Russians and pay them in rubles or whatever else so that we can get our hands on cheap energy. So does that fully solve the problem? Maybe, maybe not, but it'll definitely help in a very meaningful way. But what that will do is it will pretty meaningfully change the entire structure of the monetary system. The whole relationship that's really defined our current monetary system for the last several decades is the sort of petrodollar construct, i.e., energy pricing is done in dollars. Now, we've already seen the likes of, India, China, others sort of saying, hey, Russia, we'll pay you whatever. We don't really care about dollars. The Saudis have done, deals with the Chinese, not in dollars. So that's already moving away. And now if you had some of the closest US allies also moving away, that's a very seismic structural change in the post-war monetary order. The implications of which I think are, difficult to say, but it would seem to de-emphasize the role of the dollar in the globe. And so you would have to imagine, a weakening dollar as a potential implication of that. There's a third scenario that someone like Luke Grahman outlines in his excellent Forest for the Trees sort of newsletter that I'm subscribed to, where he talks about the ability to maybe add a sweetener in the form of physical gold to pay for oil as well. Again, that's not something I'll get into today's video, but that gives you kind of a flavor of some of the key scenarios of what we may see. And so practically, what can you do as an individual or as a family? This is not a drill, right? Even if some of this stuff gets resolved in the short term, we are nonetheless at the end of a long-term debt cycle. We're in this sort of fourth turning. Ray Dalio has done a lot of excellent work documenting how empires rise and fall, and you would just be absolutely stunned at the similarity of cultural and societal characteristics that we observe during times of crisis. And so if you're in any of these geographies that are particularly impacted, I would be securing food, securing energy if you haven't done already, securing, just protection for your family. We just haven't seen this in quite some time. Even if you're in geographies that are maybe a little more insulated or not as impacted, we are going to see a massive slowdown in global economies all around the world. And so if layoffs are a potential consideration, right, try to pay some debt down, build some cash. I am a forever perma-bull Bitcoin, but I also think you practically have to look at the facts of reality objectively and prepare yourself accordingly. So have some spare cash, but not too much because it's a melting ice cube. And if you're sort of maxed out, on your maybe you've got a dollar cost averaging plan that's just spitting away, accumulating a bit of Bitcoin on an ongoing basis, and you're kind of like, well, what should I do? Maybe you have kind of separate portfolio for investments and things like that. I'll tell you what I'm personally looking at. I'm looking at things like energy, things like commodities. I actually think there are a lot of interesting scenarios for something like physical gold. Again, I defer you to someone like Luke Grahman, who has gone into some of these scenarios in a lot more detail. Again, I know that is heresy as a Bitcoiner, but again, you just have to take facts for what they are, because of course we are still in this paradigm where Bitcoin trades as a risk asset. So something to think about and be aware of. And so a lot of bad things can happen, but again, all roads lead back to the same thing, which is central banks printing money to paper over the cracks of this crumbling system. There's this great thread from Arthur Hayes, says, let's play a little game called Hide Those Treasuries. And he's citing this announcement from the New York Fed where they've announced the intention to conduct what they call small value overnight repo operations with primary dealers. What this means, without going into the complexity of repo facilities, this is basically an attempt to provide liquidity in a rather indirect way. So the US government is going to continue to spend like a drunken sailor. There's no way around that. But the problem is that, like, as they issue more and more debt, more and more treasuries, who's going to buy that? Foreigners certainly aren't. They're selling treasuries in order to get dollars because of the dynamics we described earlier. Hedge funds aren't going to buy them because they're going to be a horrific investment. And so really the answer is probably US commercial banks. What the Fed is trying to do here is to give commercial banks more room to sop up more of the treasuries, because Fed is not buying, right? Quite the opposite. The Fed is letting some of this run off its balance sheet. And so Arthur hits the punchline here. I'll link this thread if you want to take a look at the whole thing, but forget about the Fed funds rate. Just watch the dollar liquidity and form a view on its future trajectory. This September, when the Fed is supposed to be draining more dollar liquidity by quantitative tightening, let's see if that is actually the case when we look at the total picture, inclusive of things like repo facilities. And so remember, dollar liquidity number go up, stonks and Bitcoin pump, and the opposite is also true. It's important to recognize, like, looking at this chart. So this is the total assets on the Fed balance sheet. And as you can see, all the pain, all the sell-off in assets that we've witnessed over the last few months, all that pain is driven by this very modest decline in the size of its balance sheet. I mean, it's barely even rolled over. And if you look at other central banks around the world, that is also consistent. So the total global, liquidity has only barely begun to be vacuumed out, and yet we see this enormous response from different markets and market participants. And this just goes to show you, is an example of leverage. Like, that shows how leveraged the system is. So the punchline in that whole entire section are, number one, be aware of these energy dynamics and the knock-on effects they can have. And I would say, really, for the next 6 to 12 months at least, like, brace for impact. It's not clear which of the scenarios we described earlier we're going to see, or perhaps a different scenario entirely that we haven't even identified yet. But take precautionary measures. Think about yourself. Think about your family. Do you have food security? Do you have energy security? These sound like crazy questions. And while they still may represent a remote tail risk, that tail risk has increased to the point where I think it is only logical to really wrestle with this and make sure you have some sort of a mitigation plan. And then practically, as it relates to perhaps, investments and things like that, like, the chaos that may ensue could easily bomb risk assets even lower. But keep in mind, given the repo piece that we just saw, I don't think we're that far away from the Fed pivoting. Something is going to break this year, and the Fed will have to pivot. It may do so in sneaky ways, such as these repo facilities instead of outright quantitative easing, etc. The bottom line there is, I think we could easily see some pretty bargain prices when it comes to things like Bitcoin and other assets that you may wish to own. So with all of that, let's now pivot and talk a little more directly about Bitcoin and some of the exciting news. So this is perhaps the little mixed bag, a little bit of hopium that we'll get, but let's go ahead and talk about some of the happenings closer to the world of Bitcoin. All right, so a little closer to home, we just saw one of the biggest difficulty adjustments that we've seen in the last 12 months. The second largest, in fact, 9.26%. So as a refresher, the difficulty adjustment is the ingenious mechanic that ensures a stable issuance of Bitcoin, even if a lot of new miners come into the scene and add hash rate towards securing the Bitcoin network. And so this is a big deal, right? Even with prices as low as they are, you still have a lot of new hash rate coming online. And so while that's tough in the interim, you can see this has pushed a hash price down to nearly 8 cents, its lowest level in 2 years. So that is squeezing the economics of miners. Existing miners are getting their margins very much squeezed here. But it is a good signal. It means that, big entities are probably betting long on mining as a viable and profitable long-term business. And so that's ultimately really bullish to see, although it's going to probably cause some pain to existing miners for the time being. But you're eventually going to see, older models like S9s get shoved out if the price of Bitcoin sort of stays roughly where it is for the time being. As we can see in this view from Joe Burnett, there's a record low 6.1% of circulating Bitcoin supply that has moved in the last month, which is typically indicative of strong hands hodling. And so, supply is tight. We see a lot of these views and charts, and some of them are correlative, some of them maybe not so much, but I do think that is interesting. But the other dimension here is that there's not really any kind of incremental new buying power coming in because everybody seems to be waiting for the price to go lower. But interesting to see nonetheless. We also had this very exciting announcement from Ross Stevens, who's the CEO and co-founder of Stone Ridge Asset Management, which has NYDIG as one of its kind of digital asset subsidiary, and they have announced the Wolf Lightning Accelerator for companies that would, come do an 8-week program, in Manhattan. And this is a big deal just because, number one, Ross and NYDIG are obviously extremely influential in the space, and it just represents a pretty big bet on Lightning, which we've continued to discuss in these monthly digests over the last little bit. So pretty cool to see there. Now, you also have the upcoming merge for Ethereum, slated or estimated for roughly September 15th. You're probably thinking, why in the heck is he talking about Ethereum? Well, I think this could have some potential interesting implications for Bitcoin. Number one, the fallout that we've seen from the Tornado Cash incident a few weeks ago has been, I think, really, really interesting to look at and study. There are certainly potential implications for Bitcoin. If you're not familiar with that incident, check out the video I made where I go into detail on that and on some of the potential implications. In the ensuing weeks following that, there's been a lot of really interesting debate within the broader community that basically boils down to a question of in what context or scenarios or what is the likelihood that we'll see censorship at the protocol level for Ethereum? Like, that's the whole point, is for this to have credible neutrality. Any system, any decentralized system that doesn't have credible neutrality is just like, throw it in the trash. That's just totally useless. Don't get me wrong, that doesn't necessarily mean number won't go up. I actually think the whole merge narrative is really bullish for Ethereum, the asset. I know that sounds crazy to say, but like the triple halving and we're now ESG compliant, all of that I think is very bullish and number go up. But if you throw out credible neutrality and have censorship at the protocol level, that just simply becomes a part of the legacy financial system and it becomes completely captured by government agencies. I don't think the jury is in yet on that. And so there's ongoing debate. Checkmatey put together a pretty good video that I think summarizes some of the key issues pretty well. Now, there are some points in his video that Ethereum advocates have debunked and sort of responded to, I think, quite adequately. But there are still remaining and lingering issues, such as the stickiness of stake. Anyone who tells you that the centralization of stake is just the same thing as centralization of mining pools for proof of work, that is simply not true. You can basically repoint your miners to a different mining pool within a matter of seconds. That is simply not true for Ethereum's proof of stake implementation. Not only do you still not have the withdrawal code written, right? Like literally people can't withdraw their stake from, say, Coinbase if they originally staked within Coinbase, which provides staking services for Ethereum 2.0. So not only can you not take your stake out, but even when you can, there will be this sort of exit queue. And so that's a lot stickier, meaning that if a big player like Coinbase decides to do protocol level censorship as a validator on the Ethereum network, you're not going to have individuals that can quickly switch out of that in order to more or less punish Coinbase. And so advocates in Ethereum have said, well, there's this concept of slashing, right? Like, you have this concept of social slashing, social consensus, meaning that you basically just destroy the stake of something like Coinbase. But think about that. Like, is that really going to happen? Are you really going to slash the stake of all these innocent individuals that have, staked their ETH with Coinbase? That seems crazy. And as Nick Carter argues in this following piece, that opens up a lot of questions. Like, there's this sort of inherent political nature if that were to occur, if we were to see these kind of social slashing wars and different dynamics. Again, to be clear, this is an enormously complex topic. Maybe I'll do an in-depth video on this. Let me know in the comments down below if you'd like to see something like that, because I think a lot of Bitcoiners have done themselves a disservice of being insufficiently familiar with how proof of stake actually works with Ethereum's implementation. And so you often look kind of dumb, honestly, repeating the same like 3 things that, we've been saying since 2017 regarding proof of stake. But I think as a community within Bitcoin, we need to get better and we need to get smarter, because guess what? I can guarantee you that a number of Ethereum influencers post-merge, let's assume that nothing blows up, and let's assume that it actually goes, at least technically well. I guarantee you there will be a number of Ethereum influencers that begin campaigning against Bitcoin because of its use of proof of work. They'll say, hey, look, we moved to proof of stake. Why can't Bitcoin? Now, in other news, we did also see BlackRock announce this private trust to give clients exposure to spot Bitcoin. So if the kings of ESG are okay with it, then maybe this is not an issue. But my point is that we can do better and attract more people to Bitcoin if we can very credibly debunk proof of stake and also highlight the features of proof of work that make it a superior overall mechanism by which to secure a distributed system. With all of that said, let's go ahead and conclude today's video. All right, so this edition was admittedly a bit of doom and gloom, but it doesn't matter what we wish to happen. What matters is what is happening and what things are. A is A, reality matters. We need to objectively look at the facts at hand and take preparations as individuals, as families, as businesses. I'm curious to hear what you think about all of this. Are there steps you're taking to prepare? Let myself and others know in the comments down below. But I hope you found this valuable and insightful. If you did, you already know what to do. Give this video a like. Use the share feature underneath this video to get this out to more folks. That really does help the algorithm these days. And as mentioned, be sure to subscribe because I'm definitely going to be following these various topics as we go forward. But for now, we'll go ahead and leave this here. As a reminder, my friends, every sat counts. And until next time, I'll see you then.